Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. In a few, I will interview Mr. Jeff Lampe. He's a principal of Hopewell Ventures and a specialist in venture capital and private equity. But first, a few words on a few stories. Drone that landed at White House. Those are some words from a headline dated January 27, 2015 at marketwatch.com. Such a headline might be filed away to be used as a gag headline by editors displeased with the results of the 2016 presidential election. Drone that landed at White House. The full headline is, Obama, drone that landed at White House for sale at Radio Shack. And you know, the president's correct. At least he's correct insofar as drones are available at Radio Shack. In my investigative reporter phase, I Googled drone and Radio Shack and found myself on a catalog page for the Parrot AR Drone 2.0 Elite Edition for sale at Radio Shack. It's sold out online. You can't get it online. You have to go to one of the stores for $399.99. It contains a camera, quote, to capture fantastic aerial footage, end quote, with high-definition live video streaming into your smartphone like you were in the pilot seat. And the unit itself is a sleek little number with camouflage detail. Now, the photo accompanying the story about the drone that landed at the White House shows a pathetic little drone with its little propellers lying in the grass, vanquished. And that is sort of where Radio Shack Incorporated is bound here in early February 2015. I should mention that at www.commercialbankruptcyinvestor.com, which is a sister site to AccreditedInvestorMarkets.com, you will find an 8-part series chronicling the fall of Radio Shack from early autumn 2014 to the present. The Radio Shack fall presents an example of the operational and financial challenges of a flailing and failing public company, but also the conflicts among key players who wish to improve their positions in anticipation of a possible liquidation. It really is, I think, an interesting story. But let's move away from the metaphorical drone of Radio Shack Incorporated and back to the actual drones. At popsci.com, that's POPSCI.com, obviously for popular science, a story dated January 16, 2015 by Kelsey Atherton is about an anti-drone device. So consider you don't like your neighbor's drone hovering over your house. Maybe you'll take inspiration from Senator Rand Paul, who in the immediate aftermath of the White House episode was quoted as saying, quote, drones should only be used according to the Constitution, but if they fly over my house, they better beware. I've got a shotgun. You can find that quote at talkingpointsmemo.com, January 28, 2015. Well, I don't know that you should really take your inspiration from Senator Paul on that. If you hit the drone and in falling to earth it damages a car or a person, you might face liability. If you're using a shotgun, a squirrel gun, not the most powerful gun, but with a wide spray, I'm told. If you hit the drone and the drone was actually over your neighbor's property, when you did it, you might be liable for the value of the drone at least. If you miss the drone, or if some of the spray Dick Cheney's your neighbor's son, who is climbing a tree, out of your sight, well, that might be very bad indeed. And these are hardly exhaustive scenarios. So I, for one, would hesitate in advising anyone to get a squirrel gun and deal with the drone. But think about it. The drone might be toting a camera like the Radio Shack drone I described a few moments ago. violating your privacy. Somebody is streaming your private moments into his smartphone. Why can't you Sean Penn such a drone? Well, the PopSci article describes the Rapere. I don't know how to pronounce it. It's spelled R-A-P-E-R-E. Maybe it's Rapere, which is an anti-drone drone. So you put this thing up in the air and push a button, and it homes in rapidly on the nearby drone. If I may read from the article, in place of missiles or cannons, Rapere will strike with string by lowering a tangle line onto the rotors of its prey. In order to find that prey, Rapere is set to be fitted with 12 fast cameras looking for the motion of another well-lit object in the low sky. Rapere flights will be short sprints designed to identify a target, attack, and return to a charging station, all within a short 2-minute fight span. So there's your countermeasure. Now you might face liability if it mistakes a golden eagle or some other protected animal for a drone. And of course, all these drones could land on other things and so on. But something's got to be done against the paparazzi, you know. Actually, the real use for such drones would be to protect nuclear reactors and maybe even the White House from surveillance and attack drones. And I think we can surmise that there will be investment opportunities and countermeasures to drones. Well, turning the page to another form of inventive entrepreneurship, from drones and anti-drones to other things, I refer to a January 7, 2015 article in the Wall Street Journal entitled, "Securities Lending is Drawing Scrutiny." The author is Matthias Riker. And this article concerns the Financial Industry Regulatory Authority, FINRA. Nobody knew what FINRA was before the financial crisis, but many of us have heard of it in those days and in the days since. Well, FINRA has established a watch list for 2015. And the watch list includes the following. Includes the phenomenon of investors borrowing at low interest rates, using as collateral their portfolios of securities. These are securities-backed loans. Maybe the portfolio is in toto, maybe a part of the portfolio. And I quote from the article, these investors, quote, use the low interest rate loans to purchase everything from homes to luxury items such as yachts at a time when credit has been tight, end quote. FINRA frets with respect to how the securities-backed credit lines are marketed and the risks the loans pose to customers. Well, I guess it's pretty obvious that banks like to make well-collateralized loans. And even when bank loans are collateralized by something other than securities, banks can often call such loans when the value of the collateral falls and can demand more collateral, just as in the case of the securities-backed credit lines. The bank can observe the securities plunging in value and require more securities, or it will call the loan. And if it calls the loan, it takes the securities, sells them, and pays itself what is owed. And if there's any left over, it goes back to the borrower. So borrowers can lose, but they can lose in every loan transaction. Going back to the article, the author notes that many brokerages have increased incentives for advisors to offer securities-based loans to clients. The article goes on to name Bank of America's Merrill Lynch unit as one of the largest securities lenders. It mentions UBS AG's Wealth Management Americas and Wells Fargo and Company, Wells Fargo and Advisors as employing similar tactics, being the enhanced incentives for its financial advisors to get these loans. And finally, the article notes that UBS's U.S. unit saw a 4% year-over-year increase in securities-backed lending. Well, okay, at this point, I guess I'm going to editorialize a little. Is FINRA going to begin regulating the practice of small business owners and startup company founders pledging as collateral for loans their equity in their own homes? It's a common practice. It presents the same risks as are identified in this article. I suppose that day must be coming because the people FINRA wishes to protect from securities-backed loans have substantial securities portfolios. Otherwise, they couldn't get these loans. And what's more, the author of the article proposes that these loans are used to buy homes and yachts. This is what qualifies for FINRA's watch list. I guess I want to suggest that simply intoning the words Bank of America, Merrill Lynch, UBS, and Wells Fargo is not enough to justify regulation. This is an example of a regulator in search of a problem, but also, one might say, an example of entrepreneurship. That is, the entrepreneurship in the public sphere exists as well as entrepreneurship in the private sphere. Well, enough of that editorializing. Let's get to an expert on venture capital and private equity. With me today, I'm very lucky to have Jeffrey Lampe. Jeff is principal of Hopewell Ventures, a Chicago-based venture capital and growth equity fund. Mr. Lampe is also co-founder of Gazelle Tech Ventures, a venture capital firm in Indianapolis. He has been directly involved in over $500 million of corporate finance, mezzanine, private equity, and venture capital transactions over his career. Jeff also currently serves as a director of Video Home Tours and National Pasteurized Eggs and several other high-growth companies. Mr. Lampe is a chartered financial analyst. And I think it's fair to say, Jeff, that your practice, your focus is predominantly technology, agriculture, software, text-based services, healthcare, and the like?
That is correct.
Well, all right. Well, we're here today to speak about early investors and venture capital. What should early investors understand? Now, early investors would be accredited investor or other sophisticated investor who got in on the ground floor, either as the principal founder or as friends and family of the founder or friend of the founder or co-venturer or something. And then we get to the stage where venture capital may be a good thing to do, and, well, what's all involved with that? So, Jeff, would you say that perhaps pre-venture capital may be the last time an investor has a prominent voice in the future of the enterprise?
You know, there are varying elements of involvement that a particular founder or executive will have after a round of venture capital is raised. Usually, management has a seat on the board, and that is a venue in which they can vocalize from the perspective of the chair that they sit in, the needs and wants and requirements, the broader team, but also fulfilling their fiduciary duty to all the shareholders. So other executives, though, may not want as prominent of a voice and may want to really take the lead behind the VCs involved. So I must say that it is a situation-specific scenario, and it really varies on a case-by-case basis. We traditionally, as VCs, want to partner with management, need to partner with management, and need to hear their voice in an overwhelming number of circumstances and scenarios. And so you never really want to quell any of those sentiments or feelings or thoughts, because these are the folks that are running the business on a day-to-day basis. These are the folks that are intimately involved in the operational details of these businesses. And so if you look at it as a collaboration, one that can be positive in nature, you're going to want to make sure that you have a proper and appropriate feedback loop to solicit that information flow from those owners or from those executives to the investors and ultimately to the board.
Well, all right. So other than lots of money, what's the, and not that that's anything to sneeze at, but what's the upside of getting venture capital backing?
Sure. So I would segment it into about 5 buckets. The first being financial wherewithal. You will, if you raise capital from a traditional venture capitalist, a traditional institutional fund, have the ability to raise capital over multiple rounds of financing. Most companies need a Series A, a B, a C, and sometimes even as long, you can go way down the alphabet, D's and E's. And that's an important element, because if your business is growing rapidly, or you have a change of course necessary, a pivot, if you will, that requires capital. And that's an important element to be mindful of. And there's another part of financial wherewithal, and that is the ability for that VC to attract fellow co-investors on a syndicated basis, folks that could potentially add extreme value to the investment group and then ultimately to the business. The second is if you have the right VC involved, they can and should be a trusted partner. You need to understand that these are commitments that VC funds are making that are for the long haul. These are 5 or more years in duration. And so you always want to make sure there's a good and positive level of goal alignment, because in the end, if the VC is making money and if you're making money, that will work for all, presumably, shareholders in that cap table, in that ownership structure. Third, legitimacy. It helps current and future prospective customers to know that you'll be around today, but also for tomorrow. That is a fearful concern of buyers of technology, products, or services, is knowing whether or not a business might have enough cash in the bank to be able to make a real run at it. Because these are marathons. These aren't sprints. So I'd also add that it also makes you potentially more formidable competitor in the sector. People track and watch much of what goes on in the financing space, and knowing that you took down, say, a multiple 7-figure round from a VC fund raises the brows of a lot of folks that you might be competing with. Fourth, network. Many VCs, above and beyond just the dollars that they're committing to a particular enterprise, have strong access to a network of executives, potential vendors, whether they're technology development, service providers, executive recruiters, attorneys, ranging from IP to contractual. There are a number of folks they've worked with. All those relationships are very valuable to a startup. And in addition, many VCs will have pre-existing relationships with potential customers, and that is also valuable. Lastly, strategy. Taking a startup to a successful enterprise is an immensely difficult task. You'll be faced with countless strategic choices. And having an experienced VC on the team, on the board, whom you can seek their counsel and their wisdom from in making the right call is important. It's very, very important.
So, I mean, it sounds like VCs are taking you to the next level and preparing you for the next levels beyond that. Could you just quickly discuss the need for multiple rounds of funding? Is it simply to get legitimacy from round 1, make it to certain benchmarks so that you're able to get round 2, and once you're on round 3, then all new vistas of opportunity and relationships open themselves up to you?
Yes, that's a well-put way of phrasing it. To put a little more color in that backdrop would be to say that different VCs fund different milestones that a startup is trying to attain. Some of them are technical. So, for example, a new product feature or a new portfolio of products they're launching. Others can just be simply and utterly growth-oriented, where a business, having de-risked or having achieved all of those prior requirements, is now seeking to really significantly staff up their sales and marketing efforts to achieve and attain a larger level of critical mass, and then eventually get to profitability. So depending on where you are on that continuum, which is a pretty wide continuum, there's most likely a VC for your needs.
So, Jeff, you've done a lot of work in the technology space, if I may use such a noun. If you're trying to get that first round with a venture capitalist and you're a tech startup with intellectual property and so on, what kinds of things does a tech startup need to do to make itself attractive to a venture capital? Not just venture capitalists, not just telling a good story, but rather, administrative things, setting up their rights in such a way that a venture capitalist will see the minimum amount of hair in the deal.
Sure. So there are, on the selling side, and being able to clearly articulate the business itself, I just want to briefly highlight a few, and then I want to get to the administrative. The first part being, be able to clearly articulate what your competitive advantage is. Make sure you've built a team that can last market fluctuations and the volatility of a startup. And third, make sure you have a really strong command of your business model, the market, and precisely what customers you're trying to sell to. We find in too many circumstances that part of the story hasn't gelled properly yet, or even the founders of the business don't quite know. So make sure that's accurate and correct before you go to market. With respect to the administrative elements, I like to lump these into the corporate hygiene bucket. Those are as follows. one, a clean legal structure. You want generally everything under a C Corp structure. Two, you want clean rights to the intellectual property. Ideally, if you've conducted a freedom to operate, that is great. If there's clean license agreements of where that technology is sourced, who owns it, where the title is, those sorts of, is it assignable? Those elements are critical for a VC to know. A clean cap table as an angel investor, having raised angel capital for your startup. If you have convertible notes versus common equity versus preferred equity, having that all in a clean, tight, needy place, knowing what's on that cap table is critical. Accurate financial statements is a must. Complete and up-to-date employment agreements, non-competes, and also, this often gets overlooked, employee non-disclosure agreements. There's a lot of turnover in startups. You don't want somebody walking out the door with your trade secrets. No hidden or off-balance sheet liabilities. And lastly, this is just from a capital raising perspective, be mindful of large debt overhangs on your balance sheet, as new incoming investors are not all that desirous of having new money go to pay off old.
Well, yes, and what it also sounds like is that, number one, the three guys or three gals who started something in their dorm room and they want to get to the Facebook level one day, well, they might consider hiring a pretty good lawyer with IP chops and employment chops, as well as a pretty good accountant who can sort out the cap table or make sure the cap table is attractive to the venture capitalists so they can make it to that second step. Wouldn't you agree?
Absolutely.
And further, this was something I introduced in a course I taught last year. They have to think in ways that maybe lawyers are more used to thinking in, which is, what if one of them becomes incapacitated? What if one of them is married and then dies? What happens? I mean, that's all part of clean corporate hygiene, is to make sure that the entity is not subject to some weird vicissitude, wouldn't you say?
I would.
Yeah. All right, so that's what's good for the investor who wants to get to the next step. Now, what does a venture capitalist want besides a good story and a clean and hygienic cap table and appropriate legal relationships? What about the shares and so on for the million or 10 million or 100 million the venture capitalist puts in?
Sure. So best describe it as, in a thematic sense, that a VC is pursuing an investment that is in essence a marriage, but with a prenup that's signed. Because you know that there's eventually going to be a divorce. You know there's eventually going to be a liquidation event, and hopefully it's a promising one. And the division of those assets takes place accordingly, and everyone prospers. So that's the overarching goal.
So who gets what under what scenarios, including obviously positive scenarios, like going public, or a positive scenario selling out to somebody else at a multiple of what you invested.
That's correct. And to really go into detail about what the VC is trying to architect as it relates to the shares or the securities they're using, one would most commonly, if you're going to raise venture capital from a true institutional fund, encounter a convertible preferred stock or a participating convertible preferred stock. And these, in essence, are a toggle that enables the VC to have the debt-like safety features that traditional senior debt has in a bad liquidation scenario.
So they get paid. They get paid first and amply.
Right. After the senior creditors are paid, if you move down that waterfall and that capital stack, they're usually first in line, at least as it relates to the equity side of the balance sheet. But then it gives them and affords them the opportunity to have promising upside under positive liquidation scenarios, as if it was a pure kind of common stock as well. These securities will also usually have a 5 to an 8% non-current dividend associated with it. And you might see things like weighted average anti-dilution. Some circumstances you'll see full ratchet depending on the macro environment or the risk profile of the particular startup. You'll see customary features like drag-along and tag-along rights and registration rights. And then, generally affirmative and negative covenants where there's a full consent required for any changes to the certificate, and even key spending thresholds. And that's all situation specific and to be worked out as part of the deal. But if a business is going to spend $500,000 on a new piece of capital equipment, for example, and it just did a $4 million raise, that's a substantial sum of money. VCs are going to want to have approval rights on that, as well as for key employees, for key hires. They'll want one board seat, maybe more, They'll want approvals for subsequent ads or changes. And you're going to see pre-money valuations for a Series A or Series B round, dependent on the stage, the sector, and the geography of this kind of company, the startup, in the 10 to 40% of the business you're going to be looking at giving away. So depending on what the capital raise is, that you have to do that math. But that's generally speaking the rule of thumb in the current market. And then lastly, one would expect to see monthly or quarterly, at a minimum, board meetings, whether those be in person or telephonic.
Okay, so from the perspective of an early investor and the benefits a venture capital structure can bring, the early investor has to remain highly engaged with the math and the rules that are being brought on board along with the money, should have counsel, and should not be afraid to ask the 4-year-old child questions. You mentioned participation. Well, my 4-year-old child mind says, all right, what exactly is that? Not asking you to define that right now, but you mentioned drag-along clauses and so on. But you were speaking in summary form. A fast-talking venture capitalist can throw a lot of terminology at you, and you don't know what it is, and you don't want to be stupid. But I think here's where you have to go ahead and pretend you're Gracie Allen or somebody who doesn't know, right?
Yeah, I think there are customary terms that you're going to receive from the overwhelming majority of VCs, but it is most definitely your job to hire qualified counsel to help you look through those documents and find out what is an equitable deal structure for you ultimately. Frankly, it's your fiduciary duty to your legacy shareholders to make sure that's such.
All right, well, let's talk about what can go wrong. I mean, even if you've reached a Series A or Series B, whereupon you have lots of funding, what kinds of scenarios have you seen? What kinds of risks have presented themselves to throw a wrench into the boiler works in the tech world?
Sure. Yeah, there are dozens and dozens and dozens of risks that we as VCs are trying to account for and then subsequently de-risk through different means and methods. What I would like to do is best communicate what I've seen over the last 15 plus years in the venture capital market and specifically to tech as some of the most common ones. And they would be bad management, just bad management decisioning. Second, undercapitalization, not having the requisite amount of dollars on the balance sheet to go out and execute the strategy. Third, there are macro shocks, things that you just can't really predict, whether it be the financial crisis of 2008 or geopolitical elements like the terrorist attacks of 9/11 that oftentimes can put little companies out of business very quickly.
So even like the West Coast labor problems with the ports in recent times.
Absolutely. I mean, trying to get key materials, key inputs that could be sitting on those boats, if it's an advanced manufacturing type of enterprise, that's a big problem. You can't predict that in your modeling.
And there are supply chain issues even in tech companies, aren't there?
Sure. And there's two others. One is, and this is an interesting phenomenon that we have observed as VCs over the years, but you can have the right product that you've designed and spent millions of dollars commercializing, but it's the wrong time in the marketplace. The market's just not ready to adopt it for whatever reason, whether it's a regulatory issue that's not quite letting it seamlessly integrate into the value chain or some other reason. And the inverse of this is true as well. It can oftentimes be the wrong product, but at the right time, where the market really is clamoring for a solution, but all of the feature sets out there by different competitors and even your company don't quite fit the bill. And so that's an interesting phenomenon to observe over the years. And the last one would be black swans. And those are true statistical anomalies and phenomenons where, perhaps to your point about the shipping issues on the West Coast right now, you can't get a key raw input or material for your advanced manufacturing widget, if you will. That could potentially cause problems. You could have to go to a secondary supplier. That secondary supplier may not be providing you with the desired quality or quantity of goods, even if they haven't properly vetted, and that could lead to a product recall. Those are a good example of black swan type of events that businesses have to contend with and the VCs have to contend with.
Can you provide examples of some of these ill fittings between business idea, which is pretty good, and the times?
Yeah. There were some very interesting, I think the best analog would be cell phone designs. Back in 99 and 2000, there were some very interesting handset designs with really tremendous feature sets. But one of the limiting factors, unfortunately, in not all circumstances, but in many circumstances, was just that there wasn't enough bandwidth to push the data feed to have, I would say, a robust interaction for the user of the phone and then into the phone to enable the type of commerce that you perhaps see or activity levels you see today. So bandwidth was, to one extent, a limiting factor. But then there's a second part of it, is in how that cascades through to the data management and the big data aspects of trying to get people really what products are best for them at a particular point in time. So, for example, the App Store, having that ability now and today and democratizing a product set because there's adequate bandwidth, because there's adequate processor speed, because there's an adequate phone now enables so much more innovation in commerce and user satisfaction that you see these things come and go, and these technology obsolescence cycles sometimes are within 18 months where you have to come out with a new feature set for a product. So usually look to cell phones because they have some of the most, I would say, intense paces of innovation and obsolescence and a need to seamlessly integrate into a value chain that will either be accepting or unaccepting. And you can oftentimes look to BlackBerry, which I think is actually rebirthing itself in a positive way, for a product that didn't quite meet the market test over a period of time.
Jeff Lampe of Hopewell Ventures, a Chicago-based venture capital and growth equity fund. It was my privilege to have you as a guest today. Thank you.
Thank you.
And thank you, everybody, for listening. This has been Accredited Investor Markets Radio. Our producer is Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.